So the topic of tonight, as everyone knows, is about diversifying your investments. So we often talk a lot about multifamily. Multifamily still is a main focus for Massive Capital, but we believe that you should be diversified in types of asset classes that you invest in. It's just a way for you to give yourself some diversification. So if you want to pop over to the next slide, Jasmine, please. So who is Massive Capital? We're going to talk our partnering opportunities, our investment strategy, and then lots of time for Q&A. So we'll go ahead and get going there.
Just a second on this slide, on that last slide. If you all don't know who Howard Marks is, you should. It's all about the market cycle, and that's a little bit about our topic tonight. It's a great read, been written quite a while ago, but trying to talk about the market cycle, and that's, we think, is very timely today. So that's why that picture is up. Thank you, Schreier, for putting that up.
So a little bit about Massive Capital's team. On the left-hand side, you have the main principals, Sanjay Agarwal, Shrar Khan, and Mike Bailey. And then across here, see, we've got people, they're so good looking, we couldn't even put their pictures up. So our team is growing so fast that all you get is a little dot till we get a good picture of yourselves. But across the top is our investor relations team. And then we have on the bottom, we have our Brad Pickett, who is acquisitions. We have a whole group here. Jen Brown is part of our asset management. And then across the bottom, you'll see Angela, Jonathan, legal counsel, Senate, who's running our education program. So Massive Capital continues to grow, and we're very excited about this. It's a great time to be in real estate, even though it can be a scary time for some people. Next slide, please. So Massive Capital has a good variety of skill set with all of the team. So we've got a lot of people that have been involved in land banking, land packaging, land development, building operations, renovations, property redevelopment. So Massive likes to partner with people that can do all of these things. One of the things that Massive is really good at is strategic partnering. And tonight you'll hear a lot more about that. Paul is a strategic partner of ours. We have several others that are part of our organization. But it's really important that you have all of the skill sets. What a lot of people need to know that real estate is a team sport. So you need to make sure that you have a great team and a lot of people that can help support you. Once Paul gets going in here, he'll introduce his team as well, Ryan and Lacey. So we'll make sure that we give them good introductions as well. Next slide, Jasmine. So we also want to make sure that we're cautious of what markets that we invest in. Okay, we like to invest in pro-business, pro-landlord, high migration states, places that are growing and doing well and also have very favorable terms for people to do real estate investing. So you'll see we're in the Carolinas, we're in Georgia, Florida. We have a big presence in Texas. A lot of us are Texas-based. We also have a presence in Denver, Colorado, Phoenix, Arizona, and even working on one deal in the Nevada area. So it's really important that we be able to do this. And what we look for in these markets is strategic partnerships. So in Colorado, we have strategic partners. We've done one deal with someone, we're working on another one. Same thing in the Atlanta market. It's very important that you have somebody that has local knowledge when you're looking to develop and grow into an area. So next one, Jasmine. So I'm definitely not gonna be the guy that talks about economic cycles.
Hey, I can cover that side. Or Paul, you wanna?
No, you go ahead, Schreier. You go ahead, Schreier.
Oh, sorry, somehow that one got in there. Yeah, if you can talk about this slide and then the cycles, that would be awesome.
Absolutely, thank you. Hey guys, sorry, I'm at the airport flying back to Houston today. I attended a conference, Real Estate CFO and COO conference hosted by IMN. Pretty awesome. We'll talk about in the next webinar all the takeaways. This slide is a couple of the ways that we bring value to our operating partners or the strategic partners. From left to right, that's the value chain from deal. We can help with the deal sourcing and everything in between. Then also the contract to close, due diligence, at-risk capital. We support debt as well, and also guarantee loans, depending on the type of loan it is. And we also bring equity and also provide asset management service. So when we partner with local operators, we help them grow the local operation. And in return, they help us understanding the local area. And that's how we went into Atlanta market, Colorado market, and also South Carolina market. And when we work with the equity capital partners, we take on the burden of deal sourcing and identifying good projects that is investable, that passes our requirements so that we can invest together. Okay, let's go to the next slide. All right, Paul, there you go. Take it away.
Oh, okay. Thanks everyone for coming tonight. Great to see you all. This is just a little bit about us. We're PSC Properties, and my other two great partners in Ryan and Lacey. So we have been partnering with Massive Capital now over a year. We've done multiple projects, and we love working with Massive Capital. We have done some developing ourselves. We've been doing this for about 25 years. My other story is that I'm a physician, and I was a surgeon, a head and neck surgeon for the last 30 years, and just retired a couple of years ago. But along this, on the side, we always had a real estate company, and we've been growing that real estate company over time. While we have this slide up, I just wanted to talk about briefly these three properties that we have on the right side. And this is part of our diversification story. So the one on the top, the Villages at Fate, that is a mixed-use property. And so there are apartments up top on the second and third floors, and on the bottom is retail. And so obviously a mixed-use facility. This is great. I mean, this is where we are in the center of this town that's growing outside of Dallas. And we love the retail on the bottom and the tenants on top. And again, a little different than a pure multifamily play, or obviously different than a pure retail play. So we love these mixed use, and that's one of our examples of a diversified asset. Secondly, here is a medical office building in Mesquite that we own. There are multiple kinds of medical office, as you can imagine. There's primary care, there's surgical care, there's surgical centers, surgical hospitals, there's physical therapy, and every other kind of medical specialty you can imagine. Well, this is an emergency room. It's an independent emergency room, and they command very high rents. And the nice thing about this medical office is that it's a long-term play. These are triple net leases, so that the owner, we are only really responsible for the roof and the foundation. And all of the utilities, the electric and gas and everything else is all the responsibility of the tenant. And these triple nets, they have rent escalators every year. We like them about 2 to 3%. And so you are assured of your NOI every year. You know what it's going to be. It's in the lease. And these are typically long-term leases, 10 years. And I think we might have a dentist that's 15 years. And we can rely on this steady growth. So it's a nice play to put this into your portfolio, to diversify your portfolio and have something like a medical office in there. And then the last one on the bottom is Berry Creek Townhomes, and we'll talk about that in a little bit, but that's a development play, and we're doing that in 2 phases, and townhomes, and we'll talk about that actually here in a minute. So you can go to the next slide, I think. Go ahead, Schreier, if you want to talk about these.
Okay. Cool, thank you. So this is on the right side, so a deal tracker, just a snippet of it. On the left side, this is what we're working on. We have 4 properties under contract. We have 4 LOIs pending. We are underwriting we have 21, I believe, if not a little more, in the deal pattern that we are underwriting right now. We have a fund which is ready, but we're holding off When the time comes, we'll start the fund. And we also started our actionable platform, and that's Senate runs that. So anybody who wants to be an equity raiser or thinking to learn how to be an operator, and that's the path. That's like a small incubator type role that we kind take on. Get to the next slide. Okay. I guess, Trevor, you want to talk about it, or should I go?
Definitely, yeah. So we're working on a really good property in Amberwood, it's called, in Fort Worth, Texas. It's 62 apartment homes. We're closing out this raise, but we definitely have some spots left. It is a 506C deal. It's going to be giving a 17% IRR, about a 1.95 times multiple of your money. Investors get a 7% prep, which means that investors get the first 7% of all of the proceeds. And then it's a 70-30 split. And once we surpass the 17% IRR, it does go to a 50-50 split. This is a great opportunity. I managed to visit the property last week. Super impressive little property. It's a nice, clean asset, 100% occupied, lots of potential for rent growth. So reach out again to anyone on the Massive Capital team. Don't miss out on this opportunity. We have another one that's secret. It's a 506B, so we can't talk about it. But what we can do, say, if you know someone and you have a pre-existing relationship with someone on the Massive Capital team, make sure that you reach out to us. It's also a very good investment. But again, 506B, we must have a previous existing relationship. And the secret, next one, another 506B is coming up. I mentioned it a bit earlier in Denver. So again, it has to be, we have to have a previous existing relationship. So we're going to talk a little bit about investment strategy and risk. Shrar, are you able to talk about this?
I'm here.
Very good.
Yes, so full disclaimer.
This is his specialty.
Got it. So on that note, a full disclaimer, this is for educational only. We are just talking about what we are actively working on. We are not CPAs and accountants and things like that, or advisors. So please consult your legal team or subject matter expert before you make a choice. So, okay, thank you. And on that note, I mean, for us, whoever decide, I mean, if we want to invest in the future run, just reach out to one of us or sign up in the portal, because we're leaning towards email communication as much as we can as well. Okay, let's go to the second slide. Right. So for us, what we say, Massive Capital team, we're a little bit more academic type buyer. And before we do it, before we buy anything, we have investment hypothesis that covers 3 to 5 years review. Then we take a position and then we act on it. So as you guys can tell, based on the real estate cycle, far left for 2021, COVID happened, everybody decided, free money came in, we were in a hunch of spending all the money, pushed up all the price, and that was in 2022. And then here we go in last 8 months or so, that drove all the way down to 2023. So we believe interest rate is higher, it's for longer, and it's here to stay for another year and a half, before we really see a substantial impact. What I meant is that, hey, if interest rate slips 25 basis points here and there, it doesn't change a whole lot, but it changed quarter points, 50 basis points, 75 basis points. That's a difference. That's a structural choice by structural differences. And that's really going to identify. And before that were to happen, we're still year and a half out. So Q4 2024, we're really going to see a big difference based on where we are today. And we'll see some incremental changes from now till then. And the question becomes, how do we act on it? Right? Massive's position being every market is a buy market, but not the way we bought in the previous cycle. Like an example, I'll talk about it. The way we bought assets in 2022, it's not the way we should buy in 2023 and 4, vice versa. Right? So on that note, if you want to click one more time, here we go. So on the right side, what we have done is I wrote down how we position ourselves. That in 2021, we were net sellers. And 2022, when the market was going crazy, we bought everything, all but one, in the middle of the core time was at a fixed debt. So our portfolio as of now, everything is a fixed rate. And only one asset that we have that is coming out due, which is Q2 next year. But 100% of our portfolio, it's on a fixed rate. 2023, we try to put our projects based on those four. One, we want to avoid recession, which is whatever project that we do. We need to sell about 2-3 years out at a minimum. Then we want to stay close to the market. That means projects that we do, we want to pay 5% or 10% if we can get the project work. So we want to pay really as much as market is asking us to pay. And the other one is to avoid unproven locations. We're not going into a tertiary market or trying to pick up some kind of a project that is we are not used to it. We haven't done it. It's not proven, that kind of work. And the last one is that we really want to reduce the tax and insurance exposure. What it boils down is that when we want to avoid the recession, we're looking for premium price product, not a cost plus, which is not a class C, rather a class A. We want to stay close to the market, and we want to buy new construction. We want to invest in new construction, and you'll see those coming out more. Unproven markets, we want to stay to the core markets. We want to stay in Dallas. We want to stay in Houston. We don't want to go down south in Brazoria or coastal areas, that kind, and reduce the tax and insurance burden, right? For us, it's a quick turnover. If we buy to sell, then we are not exposed to the insurance, such as Houston, right? Or if we have triple net assets in locations such as Houston, if the tax and insurance goes up, that's fine. We are not exposed to it directly. The tenants are, then we are the secondary. So we kind of understand and to try to come up with a hypothesis such as this, then put our projects according to those, and just to be on the better side of the market and protect the downside. Now we're going to talk about number 1 and number 4, how the next project supports our investment hypothesis, which is avoid the recession and also reduce the tax and insurance burden. And then it puts us a number, be close to the market as well. So let's go to the next slide, if that's okay. So what we're going to do, we're going to recap after this. After we go through the XSpace, we'll recap all those points that we talked about as well. But based on that, Paul, please take it away from here and walk us through those projects and how those plays were reflected into those projects that we have in place.
Sure. Thank you, Schreier. So this is our project, Berry Creek Townhomes in Georgetown. Georgetown is a very significant growing market in the submarket area of Austin. There's a lot of technology happening in that corridor, as you all may know, anywhere from Georgetown, Round Rock, all the way out to Taylor, where the Samsung facility is being built. So how we have done these developments is we do them basically in 2 phases. And the first phase is where we are now. And that phase 1, we are taking investors to acquire the land. We'll do our feasibility studies. We are in the planning stages right now, talking to civil engineers and our architects to design the product that we will put here. We're doing all of our entitlement and our phase 2 planning. There's a lot of permitting to be done, the site plans, the utilities are already here, but this is raw land that we purchased. And for this, we are offering an investment that is going to produce a 20% IRR, we predict. It's a short time frame, only 2 years. A lot of multifamily might be 5 years or so. And it will produce a 1.45 multiple in just 2 years. So we like this play a lot. This phase 1 will then be sold to a developer. That developer, that builder and contractor developer might be ourselves. And then we'll go on to phase 2 and then procure more investment for phase 2 itself. So that's kind of how these work when these developments. We do them typically in a couple of phases like this. We feel like when we do these development pieces that it's a little bit of a longer term play. So this phase 1 is, like I said, about 24 months. And then the build, the horizontal and vertical development will also be about 24 months, but again, a different project, basically, a different investment vehicle. And we like to think that we are kind of stretching this out over this business cycle. So once this is completed in 2 years with your investment, we go on to build. We feel like we might be through a lot of the coming recession. And so that's why this development works this way, and we like this a lot. So this is part of our diversification of our investments.
Paul, just to make sure, this is not available anymore. We finished the raise. We are into the execution of the phase one right now, right?
That's right. Trevor, I guess you got to say, I guess this investment, is it closed?
It's closed.
Okay.
Yeah,
so
we've
sorry.
raised all of the money for phase one, and assuming we are the developer of phase two, we would do a further round of investing for that. And again, another great opportunity in an amazing market. I know this area well. It's 30 minutes from my house, so it's a great location.
And then the next one that we feel is a nice diversified play is this facility that is called XSpace. And these are the renderings of XSpace. It is actually a flex space that was started by a couple of companies in Australia, and they had huge success in putting together these facilities. And I'm so glad that this slide has the word office in it, because this is not an office. It helps me to remind everyone this exactly is not an office. We are not here to build standard office buildings. As you know, the office market is still tough right now, a lot of people working at home, but this is flexible space. And so I think I'm correct, but talk to your accountant, of course, but I believe this is classified as storage space for tax purposes. So you would be on a storage level of that tax for this. This is the outside of it. This is being designed by kind of a famous designer out of Mexico who designs buildings like this, and we think it's just absolutely beautiful. If you go to the next slide, you can see the interior here. And this is, again, just renderings of the Houston space. So it is storage. So what do you store there? Well, you can store your grandmother's antiques, or you could store your cars. There's a lot of people who like to store their cars in these kinds of spaces, and it's awesome. However, if you go to the next slide, you'll see this is the actual XSpace that's already up and running in Austin. Our company has a unit here, and this is what can be done. And you can call this whatever you want. Now that you see it, is it a man cave? Is it a she cave? You can see down here in the lower right, people have desks, and it can be office. It can be entertainment type space. I think one of the unit owners is running a podcast out of their space. Another one is running a video company. Another one is running a cold storage company. One is running it as an art gallery. They're very cool spaces. And you can see the garage doors here that go into the space. You can, of course, put your car in there. But the other thing we like about this is the community. So all of the owners kind of come out of their units and they're mingling in the hall, or there's a fourth floor lounge as well. And we mingle there, and you get to meet a whole lot of really cool people who are doing some really kind of interesting and cool things with their space. And so we think this is, again, a diversified asset. We think this has a long-term play with it. And it's just reaching significant popularity right now. Again, we will be presenting this investment opportunity next week specifically. So somewhere in here, Trevor, I would like to just kind of give a little talk about the diversification piece. And so this is our partnerships. XSpace is the company. PSC Properties and Massive Capital. But I think right in here somewhere, I do want to just give a little talk about diversification itself. So obviously, you should be diversifying your real estate portfolio just like you would your stock portfolio or your securities portfolio. The same principles apply. Investing in different kinds of properties and different kind of timelines is what this is about. Obviously, there are different kind of residential rentals, multifamily, single family, there's vacation rentals, medical office we talked about earlier, industrial, townhomes for sale, townhomes for rent, and of course, storage. So diversification of real estate assets is done to mitigate the risk of your portfolio for the long term, and it ensures an ongoing and steady growth. This is again across different asset classes, different asset types, and different geographical markets. We don't really know what's going to happen in the future, right? But based on historical data, we do know that corrections and recessions happen in cycles, as we discussed earlier. So if we are not in a recession currently, we know that a recession will undoubtedly be in our future, and we have to plan for it. And if we are currently in a recession, then we undoubtedly know that in our future, we will have a recovery. So as Schreier pointed out in the previous slide, we have to take in consideration these business cycles. It's so important to do everything you can to hedge your bets and prepare to weather these storms for this long-term growth. Diversification, of course, is one of the most powerful strategies you can have in your portfolio, and it maximizes the long-term growth. It's been shown to lower your overall risk and increases your chances of higher long-term returns. So I'd like to talk about 5 different ways to diversify your real estate portfolio. The first is by asset type. So obviously, you know about single-family homes, multifamily small, multifamily large, retail, industrial, office, and storage. And we just showed you a storage that in itself has diversification, flexible storage, self-storage, industrial. And these all hedge against the broader macro changes in the economy, obviously all the way from retail, all the way to e-commerce. We know that physical office space now is going to a lot of remote work. And so we have to take that into consideration. The second way to diversify your real estate portfolio is through a geographical location. As you know, real estate is very hyper-local. You know, one community may be booming, another community may be having a slowdown. So to hedge your bets, you want to hedge your bets against a major correction that will be occurring in any one market. You know, take Dallas or Orlando or Charlotte and how different they are. But there's all very great growth markets. And so we like to invest, of course, in a strong growth markets, high job growth, population growth, wage growth, and job diversity are things we'd look at. But, you know, everybody's investing in the Sun Belt right now, right? And so the contrarian view, as we talked about earlier, might be that you look at other, maybe smaller, but other growth markets. So it's interesting that all of us here tonight, we're going to be on a call tomorrow, and we're going to be talking about a property in South Dakota. Now, a lot of people don't know anything about South Dakota, but there's some growth markets there that are very steady, very growth oriented, and have a significant history of steady growth over time. So we're going to check out that property. We don't know we're going to invest in it yet, but that's just an example of how we diversify our geographical location. And of course, number 3, diversity can happen by asset classes, right? You all know about Class A, Class B, and Class C, and how the economic cycle will shift renters maybe from A to B to C. I mean, they do have to live somewhere. So even, you know, C properties can certainly be a good investment in certain economic times, of course, as well as A and B. Another in diversity that you can do for your real estate portfolio is by strategy and by hold time. You can have You can buy and hold. I know a lot of investors who never sell their properties. They buy and they hold, and they keep it for the long term. Or else you can also do the other converse strategy of the BRRRR, BRRR, right? Build, rehab, refinance, and then repeat. You can do that even within the same geographic market. So your hold time can be short, or your hold time can be long-term, or your hold time can even be generational. And the last point I want to make about diversification is active versus passive investing. If you are an active investor, you want to own your properties, you own your own business strategy. They may be smaller properties, but you might manage them yourself. And in the passive category, that's our syndication category, right? You become an LP. They're typically larger properties, and they're managed by a third party. And that's also a great way to go. It's a great way to have a real estate portfolio, is in that LP passive investing. So basically, in summary, diversification minimizes your risk and it maximizes your steady long-term growth. So we ask you to think about diversification, step outside of your comfort zone, try a new type of investment. Maybe one of the ones we've presented tonight and we'll present again, but this diversification will maximize your long-term growth and your overall portfolio for the long term. Okay.
And we did have the one slide, just the location of XSpace too. We sort of.
Yep, that was there. That's
that
where
there.
it's located in a great zip code in Houston, by the way. Yeah. So, Trevor, that's what I have, and I don't know if Schreier has more, or you want to go to questions.
Schreier, you want to speak up before we?
No, I mean, Paul has a fantastic way to bring everything together, and there's nothing else left. And our point is, we should not wait for the home runs, right? Take the ones, go after the ones and twos. And the point is, if we do so many right ones and twos, when the time comes, home run would automatically be there for us. Right? So step out and kind of think a little bit more broad. And business strategy is good with the cycle. Just because we did something at a certain cycle, it worked out, that could be detrimental on a different cycle, right? That's the whole point. So back to you, Trevor. Thank you. Thank you, Paul.
Yeah, thank you, Paul. And I've definitely learned this lesson myself. In fact, I am a passive investor in Paul's medical emergency center up in Mesquite, Texas. One of the things I like to talk about, and Schreier sort of mentioned it, that you diversify by asset class, you diversify by location, you also diversify by risk and reward. So, a medical center is definitely a single or a double investment. In other words, it's a safe. You're going to be able to get on base. If you always go up to bat and you're looking for the home run, you do run the risk that you're going to strike out, or you're going to not have something work out really well. So balancing your investments by their risk type, their geography, their asset class, and also we talked about their timeline. So the first investment in the Georgetown land, that's a 2-year deal. It's about a 2.5-year deal on XSpace. And so what that does is it keeps your money moving and growing, and while it's being sort of diversified. So unless you have anything else, Paul, I think we open it up if you have any questions.
I just have one more point, and again, I'm not a stockbroker, I'm not an accountant or an attorney, but you've heard this all before. It also depends on your risk tolerance. If you're a young person and you've got 40 more years to invest, maybe you are a little riskier in your mind about how you do things. But if you're older and maybe you're looking at a retirement portfolio or something, obviously maybe your risk tolerance is a little less. And maybe, again, it depends on your personality. Are you which end of the spectrum are you on? So you really have to take that and listen to yourself and know yourself. Obviously, don't get into any investments that you are uncomfortable with in any kind of way, but do think about stepping outside your comfort zone slightly and looking at the diversification. I think that's kind of the big message tonight. And that's what we're doing as a company, right? We're looking at these other properties and we're hedging our bets for the business cycle. So.
Since you talked about the age, Paul, we feel like Massive is old and grumpy and hard. Wanting time to fix the projects, right? We're young in age, but hey, we're old and grumpy. We want to lose less, win more, right? That's the whole battle.
Right.
Good one. Back to you, Trevor.
Awesome. Anyone have any questions? It doesn't necessarily have to be about this topic. We do our best to provide good educational value. Somebody's got to have a question. Even a comment. I'm going to start calling on people. There we go. Liz, I was going to call on you.
Yeah, I know. I felt it coming. Paul, great presentation. Thank you for this. Is this, I was trying to drive it in Google Maps. Is this the XSpace? Is it close to the Aston Martin dealership?
Liz,
Right
it is across the street.
I just curious because I know somebody who has one of those little toys, and that's a really cool location.
That is that was intentional.
Okay.
Yeah, that's a great part of town. I actually, with another group, have a passive investment of a new A+ property in that area, and it's on fire. It is a really hot market in Houston. And we will be having, for any of you that are Texas-based, Central Texas-based, we're hoping to have an open house at Paul's office, which is under renovation at the XSpace here in Austin.
Yep.
But you'll get an idea of what it is. That's a goal we're going to try to do. And anyone in the Miami area as well. Mike's going to be doing a meetup there. He's going down to a Grant Cardone event. And so on Thursday night. So if you're interested, reach out to us. If you're in South Florida, you can connect with Mike. As I said, he's on an airplane right now going there. He's a mentoring student of Grant Cardone in his real estate program. This is actually a pitch one, so I don't know what Mike's pitching, but Mike gets up on stage. It's pretty impressive.
Yeah, we're going to have an event at our XSpace space in Austin, and love to have you all come and just get a look. It's one of those things. Again, it's almost sometimes hard to explain, but when you see it, you know what it is. And it's a cool space, and there's people doing so many interesting things there. I've met so many interesting people that are owners there, and they're doing so many interesting things. Literally worldwide kind of businesses are being run out of there, and other things. And we've got some professional athletes in the space, and they're running, what is it, Ryan? Their memorabilia out of there.
Yeah, Roger Clemens is running his memorabilia company out of his unit. Yep.
Yeah. And then the one in Houston, there was talk about putting pickleball courts on the roof. I'm not sure if that's going to happen or not, but there's just a lot of flexibility, and we want it to be a space where people can use it and be there. Obviously, you can go into your unit 24/7, and it'll just be a fun space. And especially now, since people are getting out of some of their traditional office, we think that they will maybe use this as kind of an office, or getting out of their home office and things like that. But so, yeah, looking forward to, and all of you will be invited. So I'll be there.
Awesome. And again, we're not saying don't invest in multifamily. We're saying be diversified. So I want to make sure I'm clear on that. There's lots of value in multifamily, but you always want to spread your investments over, as we mentioned, various asset classes, various geographic areas, all those different things, all the different time spans that they're going to be able to do. Jasmine, you want to talk a little bit about your Thursday? She's going to do a present. It's the first time we've done our webinar in Spanish. I'm very excited about that.
It's actually the second. Well, for Amberwood is the second one, but yeah, we're gonna be talking about Amberwood and just the whole syndication, multifamily investing. So if you guys know somebody who'll be interested in attending in Spanish, feel more comfortable in Spanish, make sure you share with them. I just put the link, but I want to drop it again, and it's gonna be at 6 p.m. Central.
And then you want to talk about your society as well, and I'll put a link in the chat to that. It's an awesome group.
Oh, yes. So, Massive Capital Girls Society. So, we are a community of women who are, of course, creating generational wealth, but also growing on every single aspect, personally, professionally, and spiritually. So, we get together the first Tuesday and the third Tuesday of every month. Yesterday, we had a talk, and it was so on fire. I get so many comments about it, and all good feedback. So for all the ladies who haven't been joining, make sure you sign up so you can watch the recordings, and hopefully you can join live next time, which is will be the 16th.
Trevor, I want to mention one other
Sure.
thing, and again, this falls into our diversified assets, and that's medical office. So again, I used to be a surgeon just a couple of years ago, and we owned our own clinic. And we owned our own building in our clinic, and we were very fortunate to be able to do that. And then the other major fortunate thing, we were able to own our own hospital. So we owned our own surgical hospital. We had 60 surgeon owners, and it was a phenomenal place. We loved all of the people that worked there. I really do believe that everyone there loved working there. We had 16 ORs. 320 employees, 32 beds, overnight beds, and it was a phenomenal place to work. And the energy there was fantastic, and everybody pitched in. The managers were, not sitting in an office someplace. They were helping turn over a room or taking garbage out of a room and things like that. It was all for one kind of a atmosphere. And I say all this because there are some great medical office investments out there, and we're continuing to look at those. And like I talked about with the ER and things like that, there's a lot of those that are fantastic. Steady growth, 2 to 3% rent escalators. You know what you're going to get. It's a long-term investment, but it's nice to have that in your portfolio when you're also doing multifamily and some other things. So again, a great example of a diversified real estate asset. And we'll talk about more about those, and through Massive, we'll be investing more of those and offering those for our investors as well.
Just to add on top of the diversification, right? So one way you could take a look, going into a project, we have a lot of flexibility, right? We have triple net, like MOBs, medical office buildings, multifamily. We have new construction to build, such as XSpace and Georgetown. Now, then you also have to think about getting out, right? What happens when I get out with the profit? And that's going to be a taxable event. So as a preparation to that, you want to mix it back. Everybody should mix it up with projects where you get a higher return, more tax benefits. But then you couple that with, risk-adjusted return, but with tax benefits. This is the second year that we have 80% of the depreciation that we can collect. Last year will be last year of 100%. Next year it's going to be 60%. So people who needs, I would say anybody who has a more than 50 grand of taxable amount, or you pay taxes above $50,000 or more, you really need to take a look at your tax amount, reduce that. And multifamily, especially on the commercial side, that we can get a depreciation. That is a very important asset class to review, right? Amberwood, some of the other projects that we're going to bring out, those are the tax favored projects. So mix and match it up from diversification going in, then couple that with time, couple that with the taxable events that's going to happen, and then how you play the portfolio. On that note, what we say, Massive, what we do all day long, we act like we are part money managers, part economics, and then part also operators, right? So we try to pick the projects that jives with the cycle, that jives with the tax, so you guys don't have to do much of the work. That's kind of sort of us that we debate about all day long, which projects to pick, right? So Paul, back to you.
Yeah, so we did have a question in the chat, minimum investment, and it is flexible. Our normal minimum investment is 100,000, but we have had it to where we will make arrangements for people. Our goal is for you to get your money moving to achieve financial freedom, and we want to make sure that we offer opportunities. But normally 50 is the minimum. On average, it is 100. But again, speak to someone at Massive Capital. Our goal is we're looking for people that want to reach that financial freedom through real estate investing. It's very
Thank you,
important.
Trevor.
Yeah. Any other questions? Well, we usually have more questions. Maybe we weren't so exciting, Paul. I know.
And Mike isn't here, so
Yeah, Mike's more.
Do we is there ability to just show us more on the XSpace deal? That's such an interesting project. Is there anything that's on
Next week, our goal is to do a full presentation on it. Tonight was just a sneak peek. Yeah, it's definitely a unique project. We're very excited.
Looking forward to hearing about it.
Yeah.
You bet. It's great. So again, just an example, that Georgetown project that got snapped up pretty quickly. So that one's full, but wanted to present that as well. But yeah, next week we'll really get into the XSpace one.
Yeah, for everybody who is interested and curious about this, make sure that you sign up on the portal so you can have the first view of the project. So that's the link right there in the chat.
And then one other thing too, we do have a YouTube page where we do upload all of our things that we do here. So we, all of our Wednesday night webinars are there. We do this, as I mentioned before, every Wednesday. And we're going to put Jasmine on the spot again because I like promoting Jasmine. I'm going to be the president of her fan club. So tell us about your new book.
Thank you, Trevor. Yeah, we just launched a book last weekend and it's called Powerful Female Immigrants. It's a collaboration of 24 women who just tell their story about coming to this country and facing all the challenges of not speaking the language or leaving everything behind, all that. So if you want a copy, just make sure you connect with me and I'll have copies for all my investors and all my future partners. So just reach out to me and I'll be more than happy to send you a copy. Thank you, Trevor.
Yeah, she had a big book signing last week. It was there was a lot of ladies that were there that are part of our network. Very, very powerful stories. Starting and just putting themselves out there and becoming successful. It's amazing.
And also it's gonna be a volume 3. So for all the ladies who came to this country and would like to be part of volume 3, also reach out to me. I'll be more than happy to connect you. It'll be the last one. So it's just 3 of them. I'm on the second one. And if anybody wants to be on the third one, just let me know.
Yeah, it's amazing. It's good to be hanging out with famous people. Come on, so anyone else got any questions? Somebody's got to, it doesn't have to be about any of the things we talked about tonight. Got a few minutes left. I just want to make sure we bring value.
Just want to add while people think about if you're thinking about investing and if you have a retirement account, if you're trying to use your IRA, also let us know. We are well connected with Quest. So today I helped somebody to roll over their 401k to a self-directed IRA. So if you have questions about using your retirement funds to invest in these kind of assets, please reach out to us. And we will help you all the way.
Yeah, and that's actually a good segue. Sometimes where you take your money from to invest in something. So for example, there are deals like the Georgetown deal that are not big depreciation deals. Land is not depreciable in America. So putting your self-directed IRA, which doesn't get access to that depreciation, is a really good use of those funds. So you're going to grow those funds. You're going to grow those funds tax-free through a self-directed IRA. So again, when you diversify, you want to look at where does your money come from is also important, and what type of investment it's better suited for. So again, for those of you that can get your money out of your IRA, I want to make sure that you know that is I didn't even realize it, right? I don't have a very big one. We didn't have one at work, but it is one of the highest fee-based things that happen, and that's why they leave you stuck in them when you're working there. People making a lot of money on it, and of course it's 100% dependent on the stock market, but they do have a tremendous amount of fees. And it's a great way to diversify your income. In fact, that's what I invested with Paul's Medical Center, my IRA. It's just a very good use of it.
And we are constantly looking at new investments. I mean, how many deals do we look at a week, Schreier? We look at so many. I don't want to.
I know this year 200 so far.
Yeah. And so a lot of those, of course, are diversified. And so we're doing that in our company. You should do that with yourself. And there will be more of these deals that are coming up. We love multifamily. We'll continue with multifamily. But there's these other deals that come up now and then that you really should take a look at.
Awesome.
We have a question on the chat.
About insurance.
How are we dealing with
insurance? So
insurance?
Insurance is a very exciting topic. So it's gone up a lot, so it's not such a big deal on some of the things, but for example, our property in Fort Worth that we just put under contract, you normally would be paying $300-400 per unit in insurance, and it's $700 per unit right now. And we've estimated it to grow at a much higher rate than it normally has. So insurance in Texas is definitely an issue. So you have to make sure that you have a good insurance broker. I also do know on the deal in Amberwood, just because I'm really close to that deal, we're actually part of a co-op which helps us with our rates. So we've co-opted with other multifamily owners and buy into a co-op policy. Little bit uniqueness on the deductibles and stuff, but you have to do everything you can to put money to that bottom line on the NOI. Well, awesome. I mean, in theory, we have 2 minutes left. Come on, don't. If you're burning, ask a question. We don't want to keep saying you got a question, so that's the last time I'm going to ask. Really appreciate you, Paul. It's a pleasure working with you and getting to know you better.
Thanks, Trevor. You too.
And everybody, and thanks. I knew I could count on Liz to at least say something. Liz is one of my new favorite people. So we talk a lot now.
Oh, you too, Trevor. And you didn't say anything about you and your wonderful, amazing story. So.
Yeah, so I'm very diversified. I'm a passive investor, 20 investments. So I've invested in everything from land acquisition to value add apartments to new A-class build of new apartments. I also invested in the Georgetown deal myself. You'll find that a lot of the people in Massive Capital invest in our deals. We believe in them. We want to put our money where our investors are putting their money. We think that's an important part. We think honesty and transparency are huge, and we want to be good stewards of your money, and that's important. I want to go to bed at night knowing that we're doing what's right, and we're making the world a better place. And the only other question I'm going to say, because we got the 1 minute left, I didn't start investing in real estate till I was 57. So my word of advice to everybody is don't wait to buy real estate and wait. Boy, I knew about it, and silly me, because it is a really good way to compound your wealth. There's no other country that you can use debt leveraged assets and get massive tax breaks for them. The United States is an amazing country for investing in real estate. Really is.
Well said.
And it's a great way to create your legacy. So I don't know, Shrar, if you're, I don't know where you are.
Yes, I'm back. I just checked the security. What's up, man? What's the question?
No, we're saying good night. I'm beating them to death to ask for questions. And so now we were just closing out.
Okay. I saw a question about the insurance. I don't know. I
Yeah,
typed
we
in a comment.
mentioned that it's very challenging, but you go ahead because you're dealing with it a lot. I know right now.
It hurts, it bleeds. But what we have done, a couple of things. We started talking with the insurance company about 90 days ahead, so we can figure out, kind of shop around hard. That's one. Number two, for a Pasadena property, the insurance went up by about, initial insurance went out almost 180%. Then we shopped it, brought it down to about 132%. And that's where we at. So for us, on the cash flow perspective, we increased the reserve, and we're baking in the rent about $3 or $5 here to kind of make sure that we can cover to some of the costs that we have. So it's a mix of the beast. We believe that, market is pretty efficient. As an operator, we'll take a bit down on the tax and insurance for this year and next year. And as soon as you come out from the recession, we expect the rent bump quite heavily to recoup some of the costs that we are paying right now. So cash flow will be low this year, probably up until mid next year. Then Q3 and 4, we should expect a higher rent increase in the Houston market quite a bit. So we are just really playing with the money right now and preserve as much cash as we can to go through it. And on the tax, up until now, we never got into litigation, but now our standard practice is every time we file a tax protest, right after that, we file a lawsuit with the Harris County. And typically in the Harris County, it lasts about a year and a half, but you recoup some of the money back that way. So it's all about filing tax lawsuits and negotiating with the insurance company every 3 months instead of every 12 months. That's how we're going at it. Back to you, Trevor.
Awesome.
Trevor,
Well,
can I just make a last comment here? I just want you all to know that our company is very blessed to be working with Massive Capital. This is a phenomenal group. They're growing. They're getting lots of people involved. They're covering all of their bases. And one thing I like to say is that all these economic times, it scares people, but this group, and I think hopefully our partnership together, we are going to continue to do deals. And we may not always be buying, but we are always looking. And so we're constantly scouring the horizon for deals, and then the deals that we look at and we archive, we take all that data and put it into our database, and now we have our own database. And so that's just amazing. And so great group to work with, great group to invest in, and love Massive Capital.
Yeah, and it's quite interesting too on the database. Often the deal comes back around, and you pull up all the old underwriting, all the old things, the price you offered, and update and go back in. And a couple of things have happened where we've gotten deals that way. You cannot overpay.
So couple of things, right? So we had, back to the conference I was in LA, those are for institutional, right? It's a CFO and COO conference for the real estate. And my objective was how, all the things that we hear, big guys here putting the pencil down, they're not buying it, yada, yada, yada. I wanted to know why and what do they know that we don't? So case in point, I met a group, CFO, he was in a panel, I was in one of the panels. He said they own 28,000 units of apartments in the West Coast area. Let that sink in, 28,000. That's like buying almost half of Houston, right? And they said they saw it coming long time ago. Last year, from their internal database, they saw rent drop, they saw higher delinquency, they saw lower application and lower closing. And then they throttle back, preserve all the cash. Now they're doubling down. Whoever is hurting in the Phoenix market, all the other markets, he was like, I have my own database. I run my own model. I know where to go buy, and I know who's hurting. That's pretty amazing how those big guys have those extra data that most of us, we don't. Then we have to go different ways to go about it. And I was explaining what are we doing in the Red IQ. He was just laughing. He was like, yeah, that's a good way to go. But I have my own data, right? But the point is, back to you, Paul, it's data is so important. And if you have it, that's gold mine, right?
Right.
And
right.
Awesome. Well, we thank everybody for hanging out with us. We hope that we see you next week. And it's always great. We always try to bring some value. So again, if you found some value, please invite a friend. The more the merrier. And bring your questions next week. Awesome.
Hey,
thanks everybody.
there's an after party? You're gonna just shut it down like this? Come on now. We're gonna keep up the 20-30 minutes after party, right? We like to drag things along. Come on, Trevor.
All right. So the after party, that's an open session to talk about anything.
That's right.
I'm not as fun as Mike.
No, hold on. Jasmine, so I was in a panel in diversity and also the women leadership. There were so many women out there doing amazing work. I got about 3 connections. I talked to them about you and our team. It would be great for them to come to your host or your events and host them. And each of them, I believe, one runs a $2 billion portfolio. She was the COO. Another one, she's I think CFO of a $700 million portfolio. Pretty amazing people.
Oh my gosh, I'm excited.
I mean, those guys are amazing. I mean, they're just fantastic. You see, like, wow. So I made some good connection for us.
I love it. Thank you so much. We're gonna send you more often.
We'll be there, Jasmine.
We will be there. That's one of the things that when we're bringing speakers, we want to have women who are like 10 times ahead of us, so we all can get value, we all can learn, and also it's really cool that they also touch on their personal lives, their spiritual lives, because growing these portfolios and dealing with all these things, it is important to talk about our struggles, personal life, professional life, spiritual. So that's amazing. I'm excited. If anybody else know women who will be great fit for the speakers, just let me know.
Yeah, they won't let me come.
We have more people in the waiting room.
Oh,
Awesome.
anybody have anything they'd like to share or win this week?
Hey, Paul, are you in Sioux Falls today?
I am.
Have you walked it at all, or did you have a chance to meet me?
No, it's in Rapid City, which is 5 hours from me. So yeah.
Okay.
But we're going to talk about that tomorrow. Yeah, it'd be great.
That sounds interesting. I don't know. I mean, from legacy to the location, what I understand now, that as long as your city is two-way blocked, like you cannot grow. You have a water, you have some kind of a mountain, and another side you have a freeway and a little bit more tapped out from the major city. They are getting a premium pricing for everything.
Yep.
It's like in Denver, when I was here last weekend, I was talking to one of the owner-operator. This is what it said, or at least from the data we saw it, but it didn't quite make sense. But then this is what it said, that from the freeway, so east side of Denver, the further you get, the closer you get to the mountain, the property price, rent, everything else goes higher and higher. People want to see. Then I took that, I went to Sioux Falls, and Dakota said, well, what the Mount Rushmore, is that true? That is exactly true. Closer you get to the mountain, higher the price. Then I took it, went to California. I was like, let me kind of float it again. Same thing. Closer you come to the water, more expensive it is.
Right.
It's kind of cool.
There's some beautiful views out in the Black Hills and that area, and you all know Mount Rushmore is out there, and so just gorgeous views, great nature area, and people love being there. And we like to say that the billionaires in Montana are kicking out the millionaires, and so they're coming to South Dakota and the Black Hills. So,
is that in Rapid City?
Yeah, Rapid City.
We were on an RV trip last year toward the U.S. and we stopped through there. Phenomenal, beautiful.
Yeah.
Mm-hmm.
Yeah, thank you. Yeah, it's like a mini Rocky Mountains, and it's beautiful area. Fly fishing, all those kind of things that you want to do, and they have the motorcycle rally out there in Sturgis and things like that. So Yeah, so we're looking. We already have properties out there. We're already building. We're developing out there. We have about a little over 1,000 units under construction right now, and so we have more land to that we purchased that we'll build in the next 2 years. Try to stage that and cycle it. But then, yeah, tomorrow we're talking about another property out there that we might JV with another group. But yeah, so
Awesome.
it's a fun area. Yeah.
And on that note, I met the guy who's the data engineer for Cherry, and him and I were debating how to identify the locations and how to play against the conventional thoughts, right? So then we bought Howard Marks again, and Howard Marks, as you guys know, he likes to be contrarian thinking, but now his new thing is you gotta be intelligent contrarian. That means not just taking a different position with a hypothesis, right? So we got into a dinner table, 2 hours conversation. One thing we found out is that areas where you have high insurance, and taxes, if the revenue is more bullish, then we should buy assets where we are not exposed to the insurance and taxes. And I think about the whole state of Florida. It was out. And we're like, no, you can buy triple net assets in Florida because the exposure goes to the tenant, not to you. That was kind of cool. It was really cool yesterday. So.
Yeah.
South Dakota is like Texas, and there's no state personal income tax. So again, there's 7 states like that: South Dakota, Florida, Texas, Nevada, and South Dakota is one of those. And so it's a great growth state. It's a very pro-business state. There's a lot of banks in South Dakota. There's a lot of high-level family trusts in South Dakota because of the laws, the business laws and usury laws. So yeah, a lot of business growth there.
So for those of you that don't know, I'm from Canada, and this is the view of Mount Rushmore from Canada.
That was the best start of the presentation today.
That's a great one, Trevor.
Yeah, that's
Okay,
the view of Mount Rushmore from Canada.
Yep.
Thank you all for coming. It was awesome.
Yeah.
Great.
Appreciate it.
And on that note,
Yeah, sorry, that's an interesting way to end the webinar. We should have probably paused record. We might get banned on the internet.
Hey, this is after hour, right? Everything goes, so no big deal. Appreciate it, Trevor.
And I
Hope
didn't
you
even
all-
notice, sorry, Bruce, that you were on the call. Bruce is our partner that brought us the
Hey, Bruce.
Emberwood deal in Fort Worth, Texas. I don't know if you can unmute and say hi. Sorry about that.
Bruce
Always
is like
in a
I'm
coffee
mountain
shop
biking,
when-
breaking another bone, right?
Yeah.
No, I'm here. I was clicking buttons, but it wasn't showing up.
Hey, Bruce. Good to see
Hey,
you.
y'all.
Hey,
Yeah,
Bruce.
good to be seen.
Yeah. Good to see you, buddy.
So Bruce is
I'm
the
going-
one that
I'm
brought
going
us
to-
the deal.
I'm going to visit the Canadian side of Mount Rushmore. I'll be back soon.
knowing you, yes, you love that one.
Oh dear.
Well, I'm glad you could join us. Yeah.
Yeah, it's good. It was very informative. I decided I got to get on more of Massive's presentations because you guys have a wealth of information, and I'm kind of stuck in my box of small to mid-sized multifamily. So it's good to see what else is out there. And I'm super excited because we have a Spanish speaking network here in Phoenix. I forwarded the link to Jasmine's webinar to them, and the host messaged me back and said she'll be sure to be on. So,
That's
so I'm
awesome.
pretty excited to see it. They do quite a bit of investing, and they bring a lot of money from Mexico into their group. So we'll see if they can bring some in ours.
That's awesome.
Hey, Balaji, good to see you. We're connecting next week, right? In
Yes,
Austin?
yeah.
Very good.
I'm looking
Awesome.
forward.
Looking
Can you hear me?
Yeah,
Yes.
I can hear you. Yeah.
Oh,
Look
okay.
forward to meeting in person.
Yeah, thank you.
Hey, Balaji, for audience, how many startups you have flipped so far? If you don't mind.
Yeah, no, I made good money with a couple of companies, so I'm looking for the next one. Let's see how it goes. Yeah.
Just guys, just think about it. We buy apartments, right? Sometimes I call it we buy businesses, and this guy flips businesses, right? It is pretty cool. it's impressive, Balaji.
Thanks. Hope I have another 5-6 years I can do that and then retire.
Man, market is wide. After today, that thing I was sending that to you, it's crazy.
I know, and it's very interesting. Maybe we'll talk offline, but I think I have worked in hardware companies which are kind of 40 years old. I see the same thing with, in terms of technology. I see the same thing with real estate, maybe 10, 15 years old. There's a lot we can bring in.
One other little tiny topic I want to bring up, and reason why I invest and why we're doing that is because we are putting together a company for our kids. And so Ryan Sink is on here. He's my oldest son and my right-hand man right now, and it's awesome working with him. We have a lot of fun. Lacey, I think, had to jump off, but she's our creative lead, and she puts together all of our webinars and all of our graphic design and things. And she's about to get married here shortly, and so just got engaged, and so that's awesome. So I'm saving for that too. But I just wanted to point that out, that we talked about short-term goals and long-term investment and generational investment, and that really appeals to me, to have this generational investment that hopefully I can pass down to them. And I always say this, I want to teach them how to fish instead of giving them fish. And so that's something real dear to my heart, and a big reason why we're doing what we're doing.
Definitely. Awesome. I'd add that I feel very fortunate to be able to work with my dad. So it's a joy for me to kind of learn and grow with him as well, and kind of do this together. So it is, if you have the chance, I recommend it. I'm not sure how everyone's family dynamics are, but for us, it works really well.
So Ryan, I have a question. So how did your dad convince you? Because I have 2 daughters. They don't want to do anything that I do. So.
Man, count me in too. That's like everybody's house. Nobody wants to do anything what we do, right? And it's like there's like an offshoot, Like
well,
outliers.
It's funny, I kind of, I was a biology major, so I was kind of following his medical path initially, and then kind of, changed my direction there. And, he had PSC kind of growing on the side. I think 15 years ago, you kind of started investing with PSC. And so I always kind of knew he was growing this sort of, portfolio or this sort of real estate company. And I just, I see my role as the generation to keep the ball rolling and to not screw it up. So that's really my role, is to kind of, stand on the shoulders of those before you and kind of, take the baton from them and really kind of carry it on. So I think it takes a little growing and maturing a little bit. I'm not sure how old your kids are, Balaji, but obviously, like anyone, you kind of grow and change your passions and your interests and what you kind of want to make your career as. And for me, it really took kind of going through the medical school route and the PA school route and doing other things, and starting as an analyst with Legacy and learning a lot there, and really just seeing the potential of this industry. And just kind of seeing where it can take you. So it takes a little time, I think. I was 26, I think, when I really started to kind of, got my real estate license and kind of got involved, and I'm 33 now. So it's been a great, couple of years of really learning and growing in this business. So just give them some time. They'll come around.
Nice.
Schreier, you've seen how Ben operates. He came into the business 8-9 years ago. He's 29. And he's far surpassed me on certain segments of the business. And it's pretty exciting to have the father-son team. And you guys have worked closely, Schreier and Sanjay have worked closely with Ben on this Amberwood deal, and you can see where he shines. So I feel pretty blessed to have him on the team for sure.
Yeah. Man, he's a copy of you. It's like exactly carbon copy. It's a young version of you. You have done well. And full kudos to you.
He's got a more massive beard, though. Mine's pretty thin.
Same with Ryan and me.
I'm not going to be part of. Y'all can have your beards and hair, all this other good stuff.
Yeah, the family dynamic does introduce its own challenges, but also brings its own blessings. So it's pretty exciting for us.
It does, Bruce. I was amazed how well I think it's working, at least, and it's a joy every day to be able to speak with your kids and plan projects and do projects. It's great.
All right, let me ask you the real question, right? All about the performance. When the performance doesn't do well, how do you guys convey that lower performance as a dad and as a senior manager to the junior managers? Walk us through, please.
No, it's more them to me. There's like, get your butt moving, Dad. Come on, let's go. Let's get some things. And I'm, they stimulate me every day. That's how it really goes. There's times I wear my dad hat and times I wear my CEO hat, but and we kind of know the difference, I think, and we know when to shut it off, because my wife says, shut it off, the business talk right now. It's not at the dinner table, forget it. So we know when to do that. It's been, again, just a blessing. It's been so much more joyful and fun and productive. And it's great to see these young people grow and learn so much, much more than I thought it was going to be. Yeah.
Yeah. To Paul's point, we have a rule that we don't discuss work around the dinner table or when we're visiting each other's houses. Works at the office and home life's at home, and it's worked really well. But Schreier, you'll have to ask Ben. Make a note of this. Ask Ben about the what's next story. He'll tell you that story when I posed that question to him early on in his career. It was a turning point for our relationship. It's pretty fascinating. But you have to ask his version.
It is also true, though. We all came from corporate, right, including you guys, and it is impressive to see how where we, in the corporate world, it's the same process, right? I come in, I graduate, I go move up in the organization, and I retire with the pot, and I'm gonna die net zero, and I'll pass on my wisdom to my kids, and they'll do the same thing. That it's a vicious cycle. At best, some of us could think a little bit ahead. You know what? My other revenue should give me enough point where I live net positive. But looking at you guys push the envelope even more, where you say, yes, the kid's gonna go, they need to grow in their own way. Nature have to correct their own process, right? So after 28, 30, they make the turn and come back, but when they're ready to come back, you can run a business, right? You can, do those bigger things where you control your time, you influence your destiny. And that is amazing how you guys are running it, Bruce, Paul, Ash, David, everybody else. So kudos to you guys, hands down.
Awesome. Well, it's been an awesome evening. Appreciate everybody for coming out. Thank you, Paul, for a great presentation. We'll see everybody next week. We're very excited about the XSpace project. We think it's going to be a good one, and
and Amberwood, and Warner Robins, and the other two secret ones. So please.
Let's go.
All right.
Yeah.
Thanks, everybody.
Trevor, thank you so much for all you've done. I think Jasmine's jumped off. Jasmine's done a great job as well. Mike's on a plane doing a great job. And Schreier, thank you for doing everything you've done. Appreciate it so much.
Thank
Thanks,
you.
everybody. Have a good night.
All right, good night, everybody. Thank you.
Thanks, everyone.
Reach
Thanks,
out to
Trevor.
us.
Thanks, Bruce.